Happy Monday, everybody. I hope everybody had a great weekend. Today is January 10th, 2022, and this is your Monday market update video. As I mentioned on Friday, another big week this week in what seems like 2 years of big weeks. So last week we saw a little bit of everything. We saw jumping bond yields. We saw plummeting tech stocks. We saw Omicron cases leaping. Wait, that sounds like a crazy circus. Well, let's jump right in. Let's wrap up last week. Let's talk about this week. We have a doozy to buckle up for this week. Guess what? Earnings are back. Okay, should have mentioned this. Spoiler alert, but let's jump right in. We'll talk about that in a little bit. Monday started off a little bit soft as we had some weak economic numbers from the manufacturing sector. That was soon replaced with optimism as to what people think the market's going to do in 2022. For those of you following the Stock Traders Almanac, Santa Claus Rally, the first two trading days of 2022 should match up with the final 5 trading days of the previous year and see what happens going forward. The market opened a little higher, then turned down with economic numbers. Then as treasuries went higher, stocks seemed to ignore that and took tech stocks and the market all higher. Now, Apple hitting $3 trillion in value, I'm sure had a lot to do with that. Remember, Apple's in the S&P 500, it's in the Dow, it's in the NASDAQ, so that helped all that. Tesla was also moving much higher as they beat their delivery estimates. The Dow and the S&P closed up a bit over 0.5%. The NASDAQ was the star of the day, up 1.2% for the day. Tuesday brought more of the rally. Remember that 2 trading days in the new year thing? Seems like that the market seems to think that Omicron cases surging with lower hospitalizations and a lower death rate indicate a final stretch is on for this pandemic. China also had some better economic numbers. JOLTS numbers and ISM manufacturing numbers offset each other, and the S&P 500 stabilized. The bond yields came off their highs. Some late selling came in and took the markets down a bit. The S&P 500 was literally down just a tad. Dow was up 0.5%. The NASDAQ, the darling of the other day, down 1.3%. Someone finally woke up and realized that with bond yields over 1.6%, so we'll see how that goes. Everyone was also setting up for the Fed minutes. So stocks sold off as the market opened on Wednesday in anticipation of those FOMC minutes. Also, we know something very important. The market does not like surprises, and we seem to be getting a lot of surprises these days from the labor market. Remember last month, but this month, the ADP numbers came in, the survey of private payrolls came in, growing at nearly double the rate that was expected. But that was nothing compared to the bomb that the FOMC minutes seemed to drop. Well, a lot of what was reported was already known. Bond buying should end by March. Rate hikes should happen as early as that. But the third rail seemingly was the balance sheet. We know that the Fed's balance sheet is huge. The minutes indicate that contrary to the fact that most people see the runoff in that balance sheet going all the way not until 2023, the Fed's talking about doing it now, in addition to tapering and rate hikes. As I said, the market hates being surprised, and it showed. The S&P 500 was down just under 2%, the Dow down 1%, and the NASDAQ, remember that winning NASDAQ from Monday, down 3.3% on the day. 10-year rates about 1.7%, just under a recent high. Thursday was another heavy open, as you may imagine. No dip buying yet, and the jobless claims were in line, but the hangover from the FOMC minutes kept the buyers on the side. Still watching for Friday's job report, there was a parade of Fed speakers, and they were all singing the same general tune. So the market churned sideways, waiting for Friday morning, and the S&P 500 finished down 0.1%, the 10-year yield to 172, the Dow down about 0.5%, the NASDAQ down 0.1%. On Friday, stocks opened pretty flat after the jobs number that everyone was waiting for came in with less jobs, but also a lower unemployment rate and a pretty hot wage growth number. If anyone was hoping that that report would lower the odds of a March rate hike, you were disappointed. And the market showed that. The market did find new lows, but it did stabilize into the close. The Dow closed just down 0.4%. The S&P closed down 0.4%. The Dow only down a few points, and the NASDAQ down just under 1%. 10-year yield traded nearly at 1.8%. It was a rough first week for stocks. For the week, the S&P 500 ended down 1.9%. The Dow was just slightly negative, and the NASDAQ was down 4.5% on the week. Santa Claus who? Just a quick note. Remember that inflation is what seems to be the key to this market. It's often defined simply as this: too much demand chasing too little supply. And as inflation right now is near 30-year highs, please note that there are 2 main things that are still there that could possibly make this thing worse. And what is that? Number 1 is Omicron. Omicron doesn't seem to be pulling back at all in the demand, but it is messing up the supply chain as we're seeing that still. Number 2, Build Back Better. If Build Back Better passes, you'll also see more demand. So we're going to have to watch this situation here with inflation. So now, a quick look at what we're going to see this week. As if all of that was not enough, I usually tell you the week after jobs week is a slow week, not this week. Sorry, we'll see Jay Powell speak at his confirmation hearings. Will he keep the same tone? The market doesn't seem to like that tone right now. So we'll see a lot of Fed speak this week. Remember a few weeks ago I was telling you that there was a fight for the headlines. It will take a lot to get the Fed off the headlines this week. Mester, George, Bullard, Powell, Kashkari, Barkin, Evans. Fun for those people who want to hear all these Fed guys speak. Remember what we've seen. Powell and the FOMC may just be testing the waters, putting out some of these talking points and the scripted talk from these Fed speakers. Keep an eye out, see what they have to say. Good bit of economic data too, but nothing will be more important than the CPI number on Wednesday, followed by the PPI on Thursday. Weekly jobless claims will be there as well. Friday, not too boring either. Retail sales, consumer sentiment. So we'll see how that goes. And as I mentioned earlier, earnings. Yes, earnings. We'll get a few smaller names earlier in the week, and then Delta Airlines on Thursday, and the all-important banks will come out on Friday. JP Morgan, we'll get to hear a little bit from Jamie Dimon, as well as BlackRock, Wells Fargo, and Citigroup. So for those of you who've been around a while, you've heard about Art Cashin. Well, he was preceded by a guy named Larry Wachtel, and what a guy that was. His comments hold true now as they did then. Quote, "It's an earnings-driven market. The big question is whether the flow of earnings can rescue the market from the twin dreadnoughts of higher oil and interest rates," close quote. Larry's been gone for a while now, but that certainly holds somewhat true now. Oil, interest rates, 10-year yield, jobs, Omicron. There's no shortage of things to watch. We'll have to see what news comes from the earning front and the rest of it too. So we'll see more volatility, that's for sure. So keep sharp and keep in touch. We'll see you Friday for another planning video, and keep an eye out for special videos coming too. Have a great week. Stay safe. Stay healthy. If you have any questions, give me a call, of course. Investing is dynamic, so stay in touch.